This is our discussion of interim financial information, which is codified according to AU-C section 930. So first, what is interim financial information? Well, we're talking about financial information which is reported on a basis for less than one fiscal year. As you know, financial statements are normally for one fiscal year. This is for somewhat less. The most common type of interim financial information will be quarterly financial statements, so once every 3 months. For quarterly financial statements, they're not the same as annual financials. They rely a lot more on estimation in order to break the client's year up into interim periods. They may also not have as much disclosure as annual financials. So it is not possible to audit interim financial information in any way. That would be trying to rely on a service which is really designed for the more quote-unquote accurate annual financials. Plus, to try to subject a client to an audit multiple times per year would be very expensive overkill. So instead, the client can elect, it's not required that the client can elect to have the interim financial information reviewed by the auditor. A review is a type of service which is far less in scope than an audit is. So with a review, the client can have some assurance given about the interim financial information. It will not be the high level of positive assurance as in an audit. Instead, it will be a lower form of assurance, which is negative or limited assurance, which says nothing indicates something is wrong. Again, not that positive audit opinion that we would have for annual financials. Also in a review, it's going to rely only on some evidence being gathered, namely through inquiry, analytical procedures, and just reading the financial statements over for obvious errors. So it's quicker, it's cheaper, and since the auditor has not gathered as much information, that again points to why we can only give limited or negative assurance. So in this section, we're going to see what's involved in a review. We're going to see some reporting issues as well. With a review, again, it's a lot less in scope than an audit, and an audit is required of a publicly traded company for the annual financials. This type of review that we will discuss here is optional, once again, and for a publicly traded company, because the SEC does not require it. In fact, we will see the review report is never filed with the SEC because that would increase the auditor's liability. In the second auditing course, we will also see for privately held companies that they may be able to have a review and save some money too, but that's for later. So let's see the introduction here. Well, again, we have guidance for conducting reviews, and the information may be presented alone or it may be presented along with annual financials and a complete annual report. So it can be either way, frequently both. Then, the account should ensure the client thoroughly understands review procedures to be applied and the procedures are substantially less in scope than in an audit. And ideally, this understanding should be documented in writing in an engagement letter. So there could be confusion because the client could think, oh, I'm getting an audit. No, that's not the case. You need to make sure that they do not have that in mind. Even though the standard says ideally this should be documented in an engagement letter, in practice, always get an engagement letter. It's a contract. And spell this out in there that they are not getting an audit. So we remind them indeed that again, the objectives of a review are substantially less in scope than an audit. And a review is designed to determine whether material modifications, so big things, should be made on the basis of inquiry and analytical procedures. And again, just reading the financials for obvious errors. In E, we bear in mind that timeliness is an important element in interim reporting. Generally, the client wants the interim financials out as soon as possible. It's another reason they rely heavily on estimates. So let's look at procedures for a review. One thing that we do very early on is to inquire about the nature of the accounting system and any significant changes in internal control. Now, probably we did last year's audit. So we can just focus here on updates. And also, by the way, another selling point to a client where this optional review service is that if we come in more than one time per year, we can help you nip any problems in the bud. And come next year's audit, which we're probably doing too, we can speed that along, save you money there, and it won't be as stressful. Then B, we'll apply some analytical procedures to identify unusual items. Here's what we should do. We need to compare financial information with preceding periods, so time series comparison. And this must include disaggregated revenue data. We concentrate there on revenue because, first of all, it's the first thing on the income statement and it drives everything else on it. So it needs to be fairly accurate even in a review. Second, revenue is almost always targeted whenever there's accounting fraud. So we look at that quite closely. So we'd like to break revenue data down, compare, for example, store to store over time, compare month to month over the past year with previous months in the previous year. So we would be looking at somehow breaking this revenue data down to get a very, very large amount of comfort on it. Then number two, we'll compare financial information with anticipated results such as budget figures. Things are too far off, we want to know why. Then third, we'll study financial information which would be expected to conform to a predictable pattern, such as industry financial ratios. Compare those to industry averages. If they're too far off, we want to know why. Then fourth, we'll compare financial information with non-financial information, just to make sure things jibe. If they don't, we have trouble. Then C, we'll review any minutes of meetings with stockholders and the board of directors because they talk about big ticket items there. We want to make sure those things are reflected in the financials. Then D, we'll read the interim financial information to determine on the basis of information coming to our attention whether it conforms to GAAP, so reading it over for obvious errors. Then E, if there have been any other accountants, we would get their report. Then F, we would obtain evidence that the interim financial information agrees with or reconciles to the accounting record, so the detailed tie-in is there. Then G, we'll inquire about the following, and we should document these, of course, in writing, but oral is a good start, but pin management down in writing. Well, first, whether the interim financial information has been prepared in accordance with GAAP, management should say yes. Then number two, changes in the client's business or accounting system, management must disclose these to us. Then third, any questions we have from analytical procedures, management needs to provide explanations. Fourth, if there are any subsequent events that could have a material effect, management must disclose them. And then management has to disclose their knowledge of fraud or suspected fraud, including any allegations of it. Then, as I said, in each, we'll obtain written representations from management about these things and also the responsibility for the financial information, the completeness of any minutes they give us, any subsequent events they're complete too, and any other matters that the auditor deems necessary. Now, some matters affecting the review procedures to be applied. Well, first, the extent of the procedures to be applied will be affected by the following. First, our knowledge of the client's accounting and reporting practices. If we've been the auditor last year, we probably have. This will be quick. And then number two, if there are any significant deficiencies in the control structure, policies, and procedures, that's going to mean additional time for us. In fact, very poor internal control could even prevent the client from performing a review of interim financial information. Let's hope that's not the case. Then number three, any change in the nature or volume of activity or accounting changes would take longer. Fourth, issuance of new pronouncements which could apply to the client would take longer. Fifth, if accounting records are located in multiple locations, that can take longer. Sixth, any questions raised performing the other review procedures, that certainly would add time because we have to clear them up. Seven, the results obtained in the client's last audit. If it's a nice, clean audit, the review will be faster. If there were problems in the audit, on the other hand, this review will take longer. And number eight, any litigation or claims or assessments against the client, we're talking about legal liability here. That can definitely take longer, and we could have some contingent liabilities coming up too. And practical, Many of these review procedures can be performed at interim dates to balance the accountant's workload. So for example, if we are dealing with interim financial statements for the second quarter of a calendar year, which would be June 30th, we might be able to do some of these review procedures earlier in June, just to balance things out. So that way, we would balance our workload and maybe even give the client a discount. We can especially do that if it's a good client. The poorer the client is, well, the closer we have to do things to fiscal year end, just like in an audit. Now, Roman numeral 4, some reporting issues. Well, first, the accountant may permit the use of his or her name only if there's been an adequate review. So if there's not an adequate review, that means no review report. So if the account scope is significantly restricted, you can't use that person's name. It would not make sense for the client to bring us in to do this optional review and then say, we're going to restrict your scope. In fact, most CPAs are going to withdraw at that point. Then B, each page of the interim financial information should be marked unaudited. It might be marked at the top or the bottom of the page, or there could be a diagonal watermark through the page. And here's an example of a clean report that we find in the SAS. So we've reviewed, not audited, the accompanying financial statements of ABC Company and consolidated subsidiaries as of September 30th, and for the 3-month and 9-month periods then ended. These financial statements are the responsibility of the company's management, again, not the responsibility of the CPA. Then we conducted our review in accordance with standards established by the American Institute of Certified Public Accountants, the AICPA. And a review of interim financial information consists principally of applying analytical procedures to financial data and making inquiries of persons responsible for financial and audit and accounting matters. It is substantially less in scope than an audit conducted in accordance with generally accepted auditing standards, the objective of which is expression of an opinion regarding the financial statements taken as a whole. Accordingly, we do not express such an opinion. So this paragraph here makes it clear that we did not do an audit. We did not follow general accepted auditing standards. Instead, these standards that were established by the AICPA, namely review standards. So we talked about how a review is a substantial step down from an audit. And notice the last sentence, we disclaim an audit opinion. Very important there, because we'll only give some negative assurance. Then a concluding paragraph, and here's the negative assurance. Based on our review, we are not aware of any material modifications that should be made to the accompanying financial statements for them to be in conformity with accounting principles generally accepted in the United States of America. So we happen to find nothing, but again, that's only limited or negative assurance, a lot less than the positive assurance or audit opinion that we have in a regular audit. Now, what if we need to modify the report? Well, first of all, reference to the report of another accountant if responsibility is shared, not too common. Number 2, what is something wrong would be a departure from GAAP, and the report should describe the departure and its effect on the interim financial information. So we just describe things as best we can. Third, if there is an adequate disclosure. Well, the report should contain an explanatory paragraph describing the information which the client should have disclosed. And then number 4, a modification is not required due to an uncertainty, such as an uncertainty about going concern of the client, or to a lack of consistency in applying accounting principles. In other words, if there's been a change of accounting principle, we don't have to say so. But both these things must be disclosed by the client. As always, even in an audit, reason for any modification should be discussed with the client before issuing the report so that the conditions can be corrected. So we give the client a chance to fix things first. If the conditions are uncorrected after that, then the actual modifications are made. Also, any fraud or illegal acts discovered should be discussed with the client and specifically with the audit committee. The accountant should also discuss other important findings with the audit committee, but the extent of the findings will not be as in-depth as in an audit. Again, we're not doing an audit, but at least this gives the client a chance to fix anything before next year's audit and hopefully save time and money then. Now, NF. The accounts report should be included if the interim financial information is included in the client's SEC filing, anything filed with the SEC. But here's something. The client must state that the review report is not an official part of the prospectus or filing, even though it must still accompany the financial information to which it pertains. So any place this interim financial information goes, if it's been reviewed, that review report will go along with it. However, there will be a disclaimer in anything filed with the SEC that this review report is not an official part of the filing. The reason is the SEC does not require a review. It is strictly a client option. And if it were to be officially included in a filing with the SEC, that would increase the auditor's liability regarding the SEC. So we don't want to do that. Then Roman numeral 5. Interim financial information, or financial statements, which accompany audited financial statements. So the preceding information concerned interim financial information which stands alone. Now let's turn to interim financial information which accompanies audited financials in the annual report. Well, in B, the same review procedures should be applied. And in C, the review procedures may be performed at the day of the audit or before the issuance of the statements. We're flexible on that. And D, I'm not really concerned about that. We'll check something here with E. Well, in E, if the interim financial statements are presented along with audited annual financial statements, the accountant should review the interims, but is only going to issue a review report on them if engaged to do so by the client. In other words, if paid to do that. So if we are not engaged to do so, we still review them because we can gain some information there for the audit. But we would not issue a review report again because we did not get paid. Let me come down to 2 short cases which I had. As far as homework on this goes, there will be no other homework, nothing from the book, nothing on my accounting lab. You do not need to turn these in, but they're simply for your own clarification. Case 1 about interim financial information. First, to discuss each of the review procedures for interim financial information. For this, let me go back and show you. You'll want to refer to, there we go, Roman numeral 2. And Roman numeral 3 is going to be for the next question. So question 2, what factors may affect the extent of the review procedures be applied? Again, Roman numeral 3. Then number 3, I want you to go back to the standard report for review of interim financial information. Just discuss each of the key factors. So that report, once again, is back here under Roman numeral 4, part C. Then the last question is about modifications. Just know what's under D, and you'll be fine. Then case 2 about interim financial information. A CPA has audited the financial statements of an SEC client for the past 2 years. The client now asks her to perform a review of the unaudited interim financial statements for the first quarter of the next year. Well, number 1, why will the CPA's limited review not provide a basis for expressing an opinion? It all goes down to this. The reason is the CPA will not gather as much information for the interim financial statements. And also those interim financial statements are not as solid in some ways, may I say, maybe that's not the best word to use, as annual financials because they rely a lot on estimates. And there's generally a pretty big rush to get interim financials done because the client wants them to go out as soon as possible. Then number 2, what are the review procedures which the CPA should perform? Again, just going back to what I had here in the handout, and those procedures are here under Roman numeral 2. Also, there are solutions to those 2 cases in a handout which I have on the portal for you. So you can also refer that if you need. I don't think you actually need to, though. So that concludes this section. Please let me know if you have any questions.